This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, as I hope you've been looking at since last time we met, you've been reviewing through the information that you can see here on the screen. What that says to begin with up here is about when we see an item of expenditure that's been incurred during the accounting period, we need to be able to identify what allowance will be available. Now, the vast majority of plant and machinery, as we know, that we as a business buys, will qualify for AIA. And with a current annual limit of £1 million, it's likely that all such qualifying expenditure will be entitled to that AIA. And that's it, you've had your 100% relief in that accounting period. If, of course, we buy cars, as we suggested, much the most likely situation for an exam question, then it's all about CO2 emissions. If we bought cars with low CO2 emissions, i.e. not more than 50 grams per kilometre, then a one-off first-year allowance would be available, and the FYA, of course, would be available whatever length of accounting period it might have been purchased in. Unlike the AIA and WDA that we'll come to in a moment, those, of course, are annual figures per annum that we're talking in terms of, not so first-year allowance. Now, what we were not aware of up until towards the end of last session is what expenditure would actually fall out of the main pool and have to instead be allocated to the special rate pool there. Now, what we've also given you to do is to look at the items to be found within the special rate pool. And you've got this little note here, which again, given that we've got such a high figure of AIA limit now of £1 million, is probably not going to be an issue in relation to the unincorporated trader that you see in any exam question. It could, however, still be brought into a company's corporate tax computation and capital allowance computation that requires within it. So I'll make the point here. I have again put some rather large numbers into a forthcoming example to illustrate this issue as well, just in case. So, if expenditure qualifying for AIA exceeds the AIA limit, then the AIA should be allocated firstly to special rate pool expenditure before then taking the balance to the main pool expenditure. We're giving priority as regards AIA to the special rate pool items rather than main pool. Why do we do that? Well, we do it, of course, because as any excess expenditure would only attract 6% writing down allowance within the special rate pool, whereas it'll be 18% available in the main pool. So what we do is on special rate pool expenditure, that if we have anything unrelieved in the period in which we buy it, we'd then only be able to get 6%, whereas main pool, we'd then be able to get 18%. Better, therefore, to take your AIA, your 100% relief on that special rate pool expenditure. If anything is going to be denied AIA this period and only rank for WDA, you would want that to be main pool expenditure, because thereafter, including this period, you'll get 18% WDA instead of only 6%. If we're going to be able to do that, then of course it's necessary to know what expenditure is excluded from the main pool and instead allocated the special rate pool. And that was then that list of expenditure that I gave you to look at here to become familiar with. Those integral features of a building. Again, we'd mentioned that right at the very beginning. We've got then a list of such examples of items that would be classified as integral features. Some that we hadn't seen before, long life assets. Okay, so long life, that must be something in terms of years there, and that is assets when new with an expected economic working life of 25 years or more. When total expenditure, again based on a 12-month accounting period here, exceeds £100,000. So we might buy an asset that has an estimated useful economic life when new of 30 years. and we think, that's long life. But we buy it for £60,000. There is then no other long life asset expenditure in that accounting period. It's a 12-month period. The figure is 100,000 in total for that period. We've only spent 60,000, in which case, therefore, the long life asset treatment does not apply, and we can instead, therefore, get our main pool item rather than special rate pool item. Now, again, the chances are that such expenditure anyway is going to be within the £1 million limit, and therefore this is a moot point. You'll get your full AIA. But if we do have expenditure on special rate, I would still ask you to show in your answer, if you're dealing with a Section C question anyway, that you are allocating that AIA firstly to special rate pool expenditure and thereafter to main pool expenditure, so that you then know that the tax written down value to go into a pool goes to the main pool. The remaining figure, that is, of unrelieved expenditure, goes to main pool, not special rate pool. Thermal insulation, just another one-off item. But the one we did mention last time, and much the most likely one for you to see in an exam question, is these higher emission cars, CO2 emissions over 110 grams per kilometre there. Note, of course, here that this expenditure, being on cars, does not qualify for AIA. So there was never a question of AIA here. So this is not going into our computation on that first list of additions, the list of additions that qualify for AIA. This one, as we'll see in a moment's time, needs to be separated out and dealt with after you computed your AIA. And if it is high emission, it means you're only going to get 6% writing down allowance. And remember, on any pool figure, these writing down allowances are on a reducing balance basis. So that amount of allowance from where you can first claim it is going to get smaller and smaller and smaller as that reduced balance reduces even further. Okay, so those, by the time you walk into the exam room, you need to be aware. The motor cars, high emission cars, much the more likely ones. Right, here we have an illustration. What we've got to do, calculate the capital allowances for the year ended 31st of March 20. Stephen prepares accounts to 31st of March, we know that, and then we're given a tax written down value of the main pool at the start of that accounting period, i.e. the 1st of April 19. This is a normal ongoing business. We're dealing with a 12-month accounting period. Important to know the length of the accounting period, to know its full AIA, its full WDA that will be available to you. Unlike illustration 1, where I made it a short 3-month opening period for a business. And that tax written down value is £40,000. That, of course, when we come to put the computation together, will be the first figure to include within that computation. We've then got our list of expenditure within the year ended March 20. So we go through that and we ask ourselves, okay, what allowances will therefore be available? Purchased plant for 50,000, normal plant. So that therefore is AIA qualifying expenditure. It is clearly a whole lot less than 1 million and therefore will qualify in full. We've then got a motor car for £11,200 with CO2 emissions of 100 grams per kilometre. Now, because it is more than 50 grams, there is no FYA. And on cars, we do not get AIA. So the only question here is what level of writing down allowance will we get and into which pool will it therefore go? And that's based, as we know, on the CO2 emissions. That figure, though above 50, it does not exceed 110, so this writing down allowance will be 18%. This is a main pool item. That is main pool expenditure. Whereas the next car that we get, CO2 emissions of 170, if you can still see underneath there, let's get rid of that. 170 grams per kilometre. Again, it's only a writing down allowance that is available. That exceeds 110, so it's 6%. And that, of course, is, let's abbreviate that, SR, your special rate pool. Finally, it's another car, of course, here, but this time the CO2 emissions, 45 grams per kilometre. That does not exceed 50, and therefore that one is first year allowance, and that we know to be 100%. Okay, so we've gone through the list of transactions, we've seen what we need to deal with. Based on that, we can now set up the capital allowance computation for this accounting period to 31st of March 20. Now we know that we're always going to need an allowances column on the far right hand side of the page, as we said in relation to illustration 1. We're also likely, and we are told very quickly here, that we do need the main pool because we know that we've got a tax written down value brought forward of £40,000 to include within it. We've also seen that during this period we bought a high CO2 emission car, which requires a special rate pool. What we then have, although you've got nothing indicating a name on this column, we can just put like a pound sign, well, there. It's useful to have a little inside working column in which you record any assets here bought during the period and then the allowances that will be available thereon. And as we know, in terms of the first category of additions to deal with, it is those that qualify for AIA. There's only one of them, the item of plant bought in this period for £50,000. It's a 12-month period. It's a £1 million limit. So a full £50,000 is available, and that transfers across to the allowances column. There's nothing unrelieved. If there had been, that would have gone to the main pool, but we've taken a full 100% AIA. Having worked out the AIA, we then turn our attention to the other additions in the period, i.e. cars now. The other additions, we got the two cars. Firstly, the one for 100 grams per kilometre, which we said was going to be main pool. We've then got the high emissions special rate pool expenditure. So, in order, the 100 grams per kilometre car, again, that is main pool, and it goes there under the main pool column title. The high CO2 emissions car, that one goes here to the special rate pool. We can now claim the writing down allowance available. What do we have on the main pool? We started with £40,000. We've added to it the car there with those medium CO2 emissions between 51 and 110 grams per kilometre. That's gone in, so we got 51,200, on which we claim our writing down allowance at 18%. Get the figure, and of course transfer into the allowances available column. We've got just one item, the item bought during the period, the high CO2 emission car, at £14,100. On it, of course, what sadly do we only get? 6% writing down allowance. Calculate, do check that that's the right number there, calculate, and again, it transfers into the allowances available column. But of course now we've got one more thing to do here, and that is to deal with the low emission car, i.e. another heading, additions qualifying for 100% first year allowance. That's the low emission car, there's the cost, full 100% allowance, transfer across into the capital allowances column. Add it up for the accounting period, and that of course will be the figure again, as we then know, to go back to where you'd computed before this the adjusted trading profit of the period, and deduct from that adjusted trading profit the available capital allowances of the period to get the tax adjusted trading profit, or indeed even maybe loss there. Tax adjusted trading profit or loss for the period. If it's a profit, as we'll then see in terms of chapter 6, we'll have to relate that profit to the tax year in which it will be assessed. Okay, have a little look through there again. Pause for a moment there and make sure that you're happy with that before then coming back, and then we'll continue with this exercise. Okay, all hopefully happy with that particular illustration there, illustration 2, in terms of how we've initially analysed the expenditure incurred during the period, kicked off the capital allowance computation with any tax written down value brought forward, usually found within the main pool, and or of course it could be a special rate pool. In or on the question page, we've effectively identified, right, the expenditure incurred this period. What is it eligible for? Is it AIA? Is it only WDA? Or is it instead FYA? That's what we needed to do. And we face, again, a similar problem here. What we've done, as you'll see from the amount of that expenditure there, is deliberately put a huge figure in that will take you above the £1 million AIA limit. But also, to give you expenditure, there you've got purchased machinery during this particular period. We'll see what that period is in a moment. Purchased machinery, which means that that is AIA, and that is going to be main pool item. We've then got the second one here, which is the purchase of, now I haven't again hidden it from you, I have called it a long life asset. You, of course, would have to remember what a long life asset is. Now, you may not do that, but possibly you might want to look back now and remind yourself what a long life asset was. Again, learn by working examples. That way it will stick. There's no good just sitting down with a list and trying to memorize this list. One item will merge with another and we'll get confused. You see it in an example, you check it out, right, I've got that, and that will stay with you. So what we have here is that too is eligible for AIA, but this one is special rate pool. And very clearly you can see that is more than £1 million. We've also during this period bought a car, therefore critical, what are the CO2 emissions to determine, is it FYA or is it WDA? And if it is WDA, is it main pool 18% or is it special rate pool just 6%? That at 105 grams per kilometre means we're talking about writing down allowance, and we're talking about main pool expenditure. What do we kick off with? Kenny prepares accounts to 31st of December. We've got to do the computation for the year ended December 19. At the start of that accounting period, Jan 19, the written down value brought forward on the main pool was £22,000. Right, we start with a main pool, so clearly we'll need that column. We've also seen that we've got expenditure incurred on a long life asset, and that is a special rate pool item. Now, you might not have needed a special rate pool, because if the expenditure was less than 1 million, of course it wasn't here, I had to deliberately make it incredibly high, but if it had been less than 1 million, what was the order in which we would allocate AIA to expenditure within this period? Firstly, to special rate pool expenditure. So if that, rather than being 1,030,000 there, had been anything less than 1 million, then AIA would be available in full. There'd be no unrelieved expenditure to put into a special rate pool. You wouldn't need a special rate pool. By me making it 1,030,000, unlikely though that number is, then that means you're going to need the special rate pool. So we've got a special rate pool set up. We've got main pool. This one is main pool, so we know where that goes. We always need an allowances column. And then, well, we can put here, see, we put that one in millions. I couldn't get it all, fit it all in here on this schedule. So that's in millions of pounds. Again, we record any additions made during the period within that little working column there. Right. Start off with what was the tax written down value brought forward. That was 22,000 within the main pool. Job done. Additions qualifying for AIA. Now, in fact, there were two additions that qualified for AIA, as we saw. The 45,000 were just normal machinery, therefore main pool, and then the £1,030,000 long life asset, which is special rate pool there. We give AIA firstly to the expenditure that would otherwise be special rate pool. That was 1,030,000. We have our maximum AIA of 1 million. The 1 million goes over into the allowances column, and the balance of £30,000, as you can see arrowed there, goes into your special rate pool. Having allocated all of the AIA limit of 1 million to the long life asset, the special rate pool expenditure, now the second category, those that would go to the main pool, the additions that qualify for AIA, the machinery cost, 45,000. There is no AIA limit available to you. If the special rate pool, the long life asset expenditure, had been less than 1 million, then some or all of that 45,000 would indeed have ranked for AIA. None of it does here, it's all been allocated. So all of that 45,000, again as you can see arrowed there, goes into your main pool column. There is then, of course, one further addition to deal with, additions that do not qualify for AIA, and that was the motor car. Its emissions were 105, which means it doesn't exceed 110, so it will be allocated again to this main pool. In it goes, get our revised total on our main pool. That hopefully comes to 75,000 there, 22, 67, yeah, 75,000. And we've got, of course, the £30,000 still on the special rate pool. Now we know the figures upon which the writing down allowances will be available. What are they? 18% in relation to main pool. Get your calculator out, prove the calculation, make sure it's the right number. Special rate pool, that is limited to 6%. Get the calculation, transfer those figures into the allowances available column, total it up. Again, if necessary, i.e. it's not an objective testing question, it's a section C question where they ask for this, get your tax written down values carried forward to the next period. There's our figure, well over £1 million there, of capital allowances to again, if necessary, deduct from the adjusted trading profit to give you a tax adjusted trading profit, or probably more likely, a huge great tax adjusted trading loss. But that's down for you to put that in, if necessary, depending on the requirement of the question. Okay, again, therefore, now, please review through what we have done so far. What you may have noticed in terms of the transactions during the accounting periods of the illustrations to now, we've only ever been buying plant and machinery. What we haven't yet seen is what happens when you sell plant and machinery. How do we deal with disposals of expenditure that has qualified for capital allowances? Guess what? That's what we see next time.